I'm Diane Rosagnola, here in San Francisco at NAREIT's REIT World, our 2018 annual conference. I'm here with Jay Whitehurst, CEO of National Retail Properties. In the past, you've mentioned that National Retail sees convenience store real estate as some of the safest and best real estate around. Does this mean the company plans to increase its allocation in this sector?
First, let me say that our portfolio is very healthy at 98% occupied, plus or minus 1%, and we're really running close to 99% occupied right now. And we have a broadly diversified portfolio that includes many different lines of trade, including the convenience store line of trade. Our convenience store portfolio is also very broadly diversified. We own over 600 convenience stores, leased to dozens of tenants in around 30 states. So it's a very safe, secure, broadly spread out group of small properties. Our convenience store tenants are some of the large operators in the business. We do business with 7-Eleven and Sunoco and Circle K and some of the large multinational operators. So we're very happy with that type of real estate. Those are well-located corners with good access and good signage and good visibility. And that leads to a high occupancy rate over time with those kind of properties. Our convenience store concentration right now is about 18% of our portfolio, and I wouldn't say that we're looking to grow that percentage in a material fashion, but I will say that if good, well-located real estate corners become available, leased to large national operators like we've got, and it happens to be a convenience store use of that property, that we would look at that very seriously and continue to do more convenience store business.
How has National Retail positioned itself in order to execute its strategy in a rising interest rate environment?
Let me just say that no company is better positioned than National Retail Properties to continue to function and do well in a rising rate environment. We've focused for many years on maintaining a low leverage balance sheet, and our debt right now is almost completely fixed rate, long-term debt on our balance sheet. Recently, we completed a 30-year bond offering. This was our inaugural 30-year debt offering. We're one of the smallest REITs to ever do that, and it was at an interest rate of 4.8%, so it was at a fantastic rate. We used the proceeds from that offering to pay down debt that comes due in 2021 at a higher interest rate. So we've successfully de-risked our balance sheet by pushing the maturities out to a longer period of time. One other factor, I think, to talk about mitigating the risk of rising rates is the high yield we get on our new acquisitions. When we invest in new properties, we are investing at around a 6.75 to 7% initial yield. That is a very high initial return on investments compared to the entire REIT industry, and it builds in a nice margin of safety for us in a rising rate environment. And the last point maybe to make is that we do not dread a higher rate environment. Our balance sheet is in great shape. Our portfolio is very healthy, and our acquisition pipeline is good. And we think that in tough economic times, the strength of our balance sheet and our business model will really be better recognized by investors.
And speaking of acquisitions, what are your projections for acquisitions in the coming year? And how important are relationship-driven transactions?
Our guidance for 2018 is for $600 to $700 million of acquisitions, and we're very comfortable that we're going to be well on target for that. Our guidance for next year is at about the same level of acquisitions. What's important to us is to create consistent multi-year per share growth, and acquisition volume is just one input in delivering that outcome, which is the consistent growth on a year-over-year, multi-year basis. That's what investors really recognize and value with our company, and it's part of what allows us to maintain the highest multiple. When it comes to acquisitions, you're right. Our primary focus is on doing relationship business with tenants, creating off-market, programmatic, repeat business relationships with these tenants. And we have successfully been able to do that. It takes a lot of time, but it gets us better real estate, better lease economics, and a better lease document. And about 75% of our dollars invested in the last few years have been with relationship tenants. We do expect that to continue, and we view that as one of the real moats around our business.
Jay, thank you so much. It's been great talking with you.
Thanks a lot.
For more from REIT World, visit REIT.com.